Hello, everyone. Welcome back to Barkley, the Investing Corgi. For today, I'm just going to cover a bit of stock market basics. No jargon, no hype, right? Just diving quickly into it. Just a friendly disclaimer, everything that I'm sharing here is for education and sharing purposes only. Nothing is financial advice. Nothing is investment or trade recommendation. And the returns that I'm sharing is all my personal returns, right? Nothing can is typical. Investing always comes with risk, right? So please invest responsibly. Do your own due diligence because after all, this is your own money that you are putting into the stock market. Right. So let's jump into it, right? So what is the stock market? So the stock market is a place where people buy and sell ownership in companies. So think of it as a supermarket, right? So in this supermarket, instead of buying your groceries, you get to buy shares of Apple, Google, etc. Each of this company has a price that a buyer and a seller agrees upon. And in this grocery shop, you can choose what business you want to own, whether you want to buy McDonald's, you want to buy Tesla, you have the freedom to do so, right? But please remember that whatever you are doing in the stock market is not gambling, right? What you're doing is essentially you are buying a piece of a business. And this is very important because a lot of times people say, hey, I buy this stock because my auntie told me to do so or my uncle told me to do so. And that's not the right mindset that you want to have, right? Because you are investing in a piece of a business. When you own these shares, right, you are really owning part of the company. You get benefit if the company grows and the share price increase. In some cases whereby stocks they pay out dividends, right? So for example, like Singapore local banks or real estate investment trusts, you get quarterly payouts, semi-annual payouts, right? Depending on their payment schedule. So you do receive those payouts, right? And of course, when you choose to sell your shares to raise cash, you can always sell to somebody else, right? And one of the most common misconceptions here is that, hey, you need to be very rich to buy many, many shares. And I think that's not true because investing starts with owning just one share. Or even now, with the low cost brokers, you can even own fractional shares. So this means that the barriers to entry of investing is even easier today than it was many years back. So why do these companies go public? I think two main reasons. They want to get access to capital, right? So they want to raise money to either expand their business, invest in research and development, or they want to hire some new talent, right? And going public definitely increases the visibility and credibility, right? People now know, hey, this guy's is listed in the New York Stock Exchange, for example, right? So there's a lot more news surrounding this business and more scrutiny, of course, from their investors. So how do you make money from stocks? I think two main ways is capital gains and dividends. So you basically sell for more than you paid. You buy 100 shares of, let's say, Apple at $100 and you sell it at $200. You get the capital gains. And secondly is the dividends, right? So the company just pays you for owning the shares, right? And typically your Singapore local banks and your real estate investment trusts, they are very famous for having this payouts with dividend yields of like 4 to 6%. So in the short term, why do these stock prices move every day, right? When you log into your brokerage account, Monday it's 150, Tuesday it's $2, for example, right? And there are a couple of reasons, right? So the first is supply and demand. If more people want to buy, the price goes up, and if more people want to sell, it goes down. Second thing that is very news driven. In the short term, a lot of this news they can drive the stock price a lot, right? So for example, earnings results, lowered guidance, jobs data, inflation data, the Fed cut interest rates. If there's company specific news as well, if they go through a scandal or merger, or even in the case in April where we saw the Liberation Day tariffs or the war in Ukraine, for example, all these things can drive the share prices. The other thing is, of course, institutional investors, right? So a lot of the volume that is driven the market is by all these large funds. And many of them are either rebalancing their portfolios so they can be entering or exiting a position. So for example, I'm selling 100 shares of Tesla at 500 and rebalancing it to 100 shares of Microsoft, for example, right? So there's a lot of changing of risk exposure and rebalancing that's going forward. Short term, I think stock markets are very emotional, a lot of noise, and they're very irrational, right? When there's massive fear, everybody starts to panic sell. And then when there's greed, people just go FOMO, right? The fear of missing out, and they start buying and buying. So in the short term, I think prices of this stocks are a voting machine. But what matters for you guys as long-term investors is actually what drives share price in the long run. And it's three main factors, right? They follow the business performance, right? Companies that make more money over time, their profits compound, and the share price increases as a consequence of that. Secondly, is the fundamentals of the business. Are they growing in revenue? Are they growing in profits? Do they have a sustainable competitive advantage, right? Because, for example, let's look at the retail industry. There's many players such as Lululemon, On, Nike, for example. Competition is very tough over there. And lastly, cash flow, right? If you have a strong cash flow and a strong balance sheet, you can survive downturns, economic downturns. But if you have weak cash flows or even negative cash flows, there's a lot of risks over there. So if you look at it, right, I think for most people, the simplest way is to invest in a low cost index fund. And I'll use the S&P 500 as a classic example, right? If you look at the returns over the long run, 30 years, 20 years, 10 years, the average return with your dividends reinvested and adjusted for inflation is somewhere between 7 to 11%. Right. And historically, the index has delivered this strong performance, but it's not in a straight line, of course. There are some periods where over the last few years, you see double digit growth, for example, but at the same time, there are periods of negative returns. Right. But if you hold it for the long run, ultimately you do get better returns, right? And if you look again at the fund managers who have tried their best to outperform the index, you will see over a longer time frame, right? Roughly 90% of these active fund managers, they underperform their index, right? And it's a difficult market for them, right? There are three main reasons as to why there's underperformance. One is the high fees that's being incurred through all this management and trading costs, expense ratio, etc. Intense competition, right? These professionals, they are competing against each other. They're even competing against algorithms, AI trading bots, right? And the more and more decisions, the more and more trades and more transactions that they need to make, it means that there's more chance for errors to occur, right? And especially if you're trying to time when to enter, when to exit, this is very difficult. So this is why you can see the underperformance of them against the index. And lastly, because of a lot of pressure, right? So a lot of them have KPIs to hit. So this kind of career pressure can lead to poor decisions for them, right? So this is it. To close off, I would say let's take a look at the lessons from Warren Buffett himself. I would say two things here, right, that I think are quotes that I like. The first quote is, I think the most important investment you can make is in yourself, right? So you're investing in a share, you're investing in a stock. You need to make sure that you do your own research and that you are making that investment because you believe that is the right choice. So you make sure to equip yourself with that knowledge, right? And the second thing is, in investing, it really pays to be patient, right? Don't chase over the hype, right? If you're seeing a share that's already running up so high, for example, Palantir, does it really make sense to buy at this price level, right? So the stock market is a device for transferring money from the impatient to the patient, right? Because ultimately, if you buy low, you sell high, that's how you make the capital gains. Okay, so if you found this useful, thank you so much and thank you for watching this video. So do help me to like, share, and subscribe. Thank you.